Good morning. Today we're bringing you a significant update that's making waves across the automotive world. Honda, a name synonymous with innovation and reliability, has just announced a major revision to its financial outlook, sending ripples through the industry and among investors. The company has slashed its full-year operating profit forecast for the fiscal year ending March 2026, a move that has caught many by surprise and sparked intense discussion among analysts. The new projection stands at 550 billion yen, or about $3.65 billion, a staggering 21% cut from the previous forecast of 700 billion yen. This sharp reduction is more than just a number. It reflects deep-rooted challenges and shifting dynamics within the company and the broader market. This isn't a minor adjustment, it's a clear sign that Honda is bracing for tougher times ahead, as it faces mounting pressures from multiple directions. Such a dramatic reduction signals serious challenges, not just for Honda, but for legacy automakers everywhere. The entire industry is feeling the heat as traditional business models are being disrupted. The move highlights the financial hurdles of electrification, the rising costs of research and development, and the fierce competition in global markets, especially as new players and technologies emerge. Investors and consumers alike are left wondering, what's driving this shift, and what does it mean for Honda's future? Is this a temporary setback, or a sign of deeper transformation within the company? As we break down the reasons behind this forecast, we'll see how Honda is navigating a rapidly changing industry, balancing tradition with the urgent need to innovate and adapt. Let's explore what's really going on behind the numbers, and what the future might hold for one of the world's most recognized automakers. So, what's really behind Honda's recent profit downgrade? Let's break it down into three major factors that are shaping the company's current challenges and future outlook. First, Honda is facing massive one-time costs tied to electric vehicle development. The shift to EVs isn't just about building new cars, it means investing heavily in cutting-edge technology, completely retooling factories, and establishing reliable battery supply chains. All of this requires billions in upfront spending, draining resources long before these new vehicles start generating profits. It's a high-stakes gamble, and the returns are still years away. Second, sales are slumping in key Asian markets, especially China. Here, local automakers are rapidly gaining ground, offering advanced and affordable electric vehicles that appeal to a new generation of buyers. Honda, once a dominant player, is now struggling to keep pace with these nimble competitors, leading to shrinking market share and declining revenues in one of its most important regions. Third, a critical chip shortage, specifically from supplier Nexperia, has thrown a wrench into Honda's production plans. Without enough microchips, assembly lines slow down or stop altogether, making it impossible to meet customer demand and further squeezing profits. These three issues combine to form a triple threat: soaring EV investment costs, falling sales in Asia, and persistent supply chain headaches. Each problem feeds into the next, creating a cycle that's tough to break. None of these are quick fixes. They reflect deep structural shifts in technology, fierce new competition, and the fragility of global supply chains. Honda is being forced to adapt on multiple fronts at once. Now, Honda must find a way to balance these immediate crises with the long-term need to build a sustainable and profitable future. It's a delicate act that will test the company's leadership and vision. The lowered profit forecast is a direct response to these mounting pressures, signaling to investors and stakeholders just how serious the situation has become. The road ahead will require tough decisions, bold innovation, and strategic pivots if Honda hopes to regain its footing in a rapidly changing industry. Honda's recent July-September 2025 results show the pressure is real. Operating profit dropped 25% to 194 billion yen, down from 257.9 billion yen a year earlier. This sharp decline missed analyst expectations and rattled investor confidence. The culprits? Soaring EV development costs, weak sales in China, and ongoing chip shortages. These aren't distant threats. They're hitting Honda's bottom line right now. The company is struggling to keep pace, weighed down by high costs and fierce competition. This disappointing quarter forced Honda to reassess its outlook for the entire year. The numbers are a wake-up call. Honda's challenges are immediate and significant. The company must act fast to regain momentum. The cost of going electric is hitting Honda hard, and the financial impact is impossible to ignore. As the global auto industry shifts rapidly toward electrification, Honda finds itself at a crossroads, forced to make tough decisions that will shape its future. The company took a staggering 224 billion yen one-time hit for EV development, covering everything from advanced R&D and new battery technology to factory upgrades and the installation of cutting-edge manufacturing equipment. This investment is not just about building new cars, it's about transforming Honda's entire approach to mobility. The expense was so steep, Honda's auto division posted an operating loss for the first half of the year, a rare and unsettling event for a company known for its steady profits. The financial strain is being felt across the organization, from the factory floor to the executive suite. It's a stark reminder that legacy automakers must spend big to catch up in the EV race. The pressure to innovate is relentless, and the cost of falling behind could be even greater than these massive investments. Unlike Tesla, which was built from the ground up as an electric car company, Honda must juggle its profitable gas-powered vehicles while pouring resources into unproven electric models. This balancing act adds complexity and risk to every decision. Investors are wary, watching closely as Honda's leadership navigates these turbulent waters. Yet the company's top executives insist that these painful investments are not just necessary, they're essential for Honda's long-term survival and relevance. The short-term pain is real, but Honda is betting that these sacrifices will pay off. The company is determined to secure a place in the electric future, even if it means enduring losses today for the promise of tomorrow. The EV transition is costly, risky, and for Honda, simply unavoidable. The company is investing in new supply chains, retraining workers, and reimagining what it means to be a leader in mobility. The profit warning is a direct result of these massive upfront bets, and it's a signal to the market that Honda is willing to endure short-term setbacks for long-term gains. Honda is gambling that today's losses will secure its place in tomorrow's market, a bold move that could redefine the company's legacy for decades to come. Facing high costs and market headwinds, Honda is scaling back its EV ambitions. The company has lowered its 2030 global EV sales target from 30% to 20% of total sales, a one-third reduction. This shift signals a more cautious, realistic approach to electrification. Honda now recognizes that mass EV adoption is tougher than expected, with obstacles like high prices and limited charging infrastructure. The revised target reflects financial pressures and the need to pace investments more carefully. It's a pragmatic move, prioritizing stability over aggressive growth. Honda's adjustment may foreshadow similar moves by other legacy automakers. The journey to an all-electric future is proving longer and more complex than many hoped. Honda's new target is a reality check for the entire industry. Asia, once Honda's growth engine, is now a source of concern. The company has slashed its regional sales forecast from 1.09 million to 925,000 vehicles, a loss of 165,000 units. This drop directly impacts revenue and profit, highlighting the seriousness of the situation. The main reason: Chinese automakers are rapidly gaining ground, offering stylish, tech-packed, and affordable cars. Honda's brand alone is no longer enough to guarantee sales. Chinese consumers now have more choices, especially in the booming EV segment. Honda's market share is shrinking, and the revised forecast is a clear admission of struggle. The competitive landscape in Asia has fundamentally changed. Honda must adapt quickly or risk falling further behind. The pressure is on to find a new path forward in its most important market. The rise of Chinese automakers is shaking up Southeast Asia too. Honda's executive vice president, Noria Kaihara, admits that aggressive Chinese brands are forcing a strategic rethink. These rivals are winning customers with feature-rich, affordable vehicles, pushing Honda to offer bigger discounts and incentives. This price war erodes profits, even if sales hold steady. The old dominance of Japanese brands is fading as Chinese companies compete on price, tech, and design. Honda now faces a painful adjustment in a region it once ruled. The competitive squeeze is a major reason for Honda's profit woes. The global auto hierarchy is shifting, and Honda can't take its position for granted. Honda is hitting the reset button in Asia. Executive Vice President Kaihara says a fundamental review is underway. Incremental tweaks won't cut it. In a surprising move, Honda has no major new models planned for Asia this year or next. This pause is unusual, signaling a deeper strategic overhaul rather than just cost-cutting. Honda may be rethinking its entire product lineup to better compete with tech-forward Chinese EVs. The risk short-term sales could fall further without fresh models. But Honda is betting that a bold, long-term strategy is worth the wait. The company is stepping back to develop products that can truly compete in the new Asian market. It's a risky but necessary move to stay relevant. The next chapter for Honda in Asia is still being written. Honda stands at a crossroads, forced to lower profit expectations and rethink its future. Massive EV investments have led to operating losses, showing the high cost of transformation. Meanwhile, Chinese automakers are eroding Honda's market share and profits in Asia. Honda's response cut sales forecasts, pause new model launches, and fundamentally review its strategy. The company has also scaled back its 2030 EV target, acknowledging a tougher road ahead. Honda must now balance declining gas car profits with risky, expensive EV bets. The steps it's taking, revising forecasts, recalibrating targets, and rethinking strategy, are just the beginning. Honda's journey to redefine itself in the next era of mobility is underway, and the outcome is far from certain.